Hello traders and welcome to today's session on oil trading strategies, where we will explain the essential techniques and insights you need to trade the oil markets. So understanding the dynamics of oil trading can significantly enhance your portfolio and open up some lucrative opportunities. In this video, you will discover the key factors that drive oil prices. You will learn about effective trading strategies and understand how to manage risk effectively. So stay with us until the end to gain valuable knowledge that could transform your trading approach and help you make more informed decisions in the oil market. So without wasting your time, let's get started. So to effectively trade oil, you must first understand the market's intricacies. The oil market is influenced by a complex interplay of factors that can significantly impact prices. So key factors influencing oil price include global global supply and demand. We have global supply and demand, have geopolitical events, geo geopolitical events, and we have technological advancements in the energy sector. So I'm just going to delete this. So in case you missed that, you can just rewatch. You can rewind a little bit and you get it. Let me repeat myself. Key factors influencing oil prices include global supply and demand, geopolitical events, economic indicators, and technological advancements in the energy sector. So for instance, tensions in oil producing regions can lead to supply concerns, potentially driving prices higher. For example, tensions in oil producing regions like the Permian Basin can lead to supply concerns, potentially driving prices higher. And we'll explain that later in this video. The major players in the oil industry include OPEC, which is Organization of the Petroleum Exporting Countries. We have large oil companies like ExxonMobil and Shell. And we also have major oil consuming nations such as the United States and China. These entities can significantly influence market dynamics through their decisions and actions. So when trading oil, you primarily encounter two main types: the Brent crude and the West Texas Intermediate, which is WTI. This is the West Texas Intermediate, which is the US crude oil, and Brent crude, which is this. This is Brent crude and this is WTI, West Texas Intermediate. So Brent crude is the international benchmark, while the WTI is the US benchmark. So understanding these differences between the two can be crucial for your trading strategy. So you can see that Brent and Brent crude and WTI, they often move in tandem. There's similar price action between the both of them. See, you can see Brent is priced at $72.9 at the moment, while WTI is priced at $69.97 at the moment. So this divergence can create opportunities for spread trading, which we will discuss later. So let's get started on popular oil trading strategies that you can use to trade the oil market. So now that you have a solid understanding of the oil market fundamentals, let's dive into the most popular trading strategies used by successful oil traders. So the first one is fundamental analysis. So fundamental analysis involves assessing the intrinsic value of oil based on economic, political, and industry specific factors. Sorry about that. You can identify potential imbalances that could lead to price movements by simply examining supply and demand dynamics, monitoring production levels, inventory reports, and consumption patterns to gauge the overall market sentiment. So crude oil inventories serve as key indicator of the supply-demand balance and the overall physical condition of the oil market. Traders closely watch weekly reports. This is a weekly time frame. This is a trading view platform. This is the weekly time frame on WTI US crude oil. See this? So there are weekly reports. EIA drops weekly inventory reports which compares actual changes in the oil market to analysts' forecast, and these reports come in every Wednesday. If there is a larger than expected build or smaller than expected draw in inventories, oil prices often react immediately by retreating, and the opposite is the same. The opposite occurs with a bullish inventory report showing strong demand. So you have a bearish week like this, it means that if you have a bearish week, it means that there was larger than expected build or smaller than expected draw in inventories. Analysts were expecting a particular draw in inventories, but the actual draw was less than expected. Was less than expected, yes. And this oil prices can react immediately by retreating, which will give us a bearish week. This is the weekly time frame. You can see this this is a bearish week followed by this bullish week and this bullish week right there. So oil inventory levels can affect the oil market. For instance, if you look at this recent price data, let's go to the daily chart. This recent price data, you can see in October, US crude oil stocks stood at 804 million barrels, down slightly by 0.15% from the previous weeks of 805.67 million barrels. So this small drawdown in inventories puts upward pressure on oil prices for the next few days. You can see that that was the first week of October. You can see that the next day was bullish, followed by the next day was also bullish. The next 4 days at the go had 4 bullish days, and you can use fundamental analysis to quickly enter this market. You can enter from when the report was released here, and you can take profit at this resistance level right here. You can see this resistance level right here, and after that you can see price retracing. So that's how you can trade the oil markets, by monitoring oil inventory levels. So geopolitical events also play a significant role in fundamental analysis. By monitoring news and developments in oil producing regions, you can anticipate potential supply disruptions or shifts in market sentiment. Economic indicators such as GDP growth and manufacturing data provide insights into oil demand trends. So for example, in February 2022, let's go to February 2022. You can see right here, and that was Russia's invasion of Ukraine, and it caused a significant spike in global oil prices. That's geopolitical events. So between February 22, which is here, and March 8, see, that was when Russia invaded Ukraine, and it caused a significant spike in global oil prices. You can see this spike from around $92 per barrel to over $123 per barrel, and that marked one of the largest price increases in recent history. That was massive. and it was driven by concerns over potential disruptions to global oil supplies, as Russia is one of the world's largest oil producers. So that was why we had this massive bullish movement right here as a result of Russia invading Ukraine. And at the same time, US economic indicators also played a role in shaping market sentiment. Strong GDP growth, as I said before, and robust manufacturing data in early 2022 indicated rising demand for oil. This is fundamental analysis now, and this supported further higher prices. You can see, even with this, we still had higher prices moving upwards, and it was as a result of strong GDP growth and robust manufacturing data. However, as inflation concerns grew and Federal Reserve began raising interest rates, there was a slowdown in economic activity by mid 2022, and this contributed to a gradual decline in oil prices as demand forecasts were adjusted downwards. You can see this downtrend as a result of inflation and Federal Reserve raising interest rates. So this is as a result of fundamental analysis. You can use it to trade oil, whether it be US crude oil spot or Brent oil international benchmark. So that is it for fundamental analysis. You have technical analysis, which is another way you can trade oil. So technical analysis is another powerful tool in the oil traders arsenal, focusing on historical price patterns and trends to predict future movements. So key chart patterns to watch for include flags, the double top and double bottom, head and shoulders formation, as they often signify potential trend reversals or continuations. Moving averages are also widely used to gauge market momentum and identify support and resistance. You can see this bullish flag right here. We are bullish, we've been bullish, have this flag. Bullish again, have this flag. Bullish again, you have this flag. So this is how you can trade using bullish flags and use it to trade the oil markets. When we were bearish too, had these flags also. It's all about retracement. So that's how you can use chart patterns to trade. You can see this this was like a double top. See this double top right here. You can see price coming back to give us this double top pattern right here. Price broke the neckline and came back to retest that neckline and give us further down prices. You can see that's using technical analysis, and also you can insert the moving average. So I'm just going to insert the moving average to show you how to use that also. Moving average. So simple moving average. So I like to use the 21-day moving average, or I'll use the 50-day. Yeah. So when price is below the moving average, it signals a bearish trend, and if it's above the moving average, it signals a bullish trend. So you can see using the moving average, we can gauge whether the oil market is bearish or bullish. You can see this price broke through this moving average right here, had this retest and further downsides. Price kept on using the moving average as resistance levels. Let's see this as it continued its downtrend through 2022 and into 2023. So when applying technical analysis, it's crucial to confirm signals from multiple indicators like the moving average or the RSI or the MACD. to increase the probability of success. However, be aware of limitations of relying solely on historical data or technical analysis, as unexpected events can invalidate even the most reliable patterns. That is very, very important. So the next is news trading. Next strategy on my list is news trading. So I'm just going to delete all of this. So oil prices are highly sensitive to news events, making news trading a popular strategy among short-term traders. So to succeed in news trading, you must stay on top of the economic calendar, paying close attention to releases like weekly inventory reports, monthly jobs data, and GDP figures. We've discussed this. Oil prices can react within minutes of this announcement, so be prepared to act quickly. OPEC meetings and policy decisions are also critical news events for oil traders. And historically, OPEC announcements um, have had a significant impact on prices. So it's essential to understand the group's dynamic and decision-making process. For example, you can see in April 25th, OPEC decided to maintain voluntary production cuts through the second quarter of 2024, which could suggest a stabilization of prices, but explicit details were not specified. So the market reaction to that OPEC meeting was bearish, with prices sliding as a result of concerns about inventory builds and the continuation of production cuts. So you can see here, this was April 25th, 2024. And you can see after that OPEC announcement, you can see the bearish movements to the downside. You can see this. You can see these wicks, this doji here, indecision candle, signaling that yes, price it's about to go to the downside. And we had this bearish movement after that, consistent three red candles, a pullback, and continuation of the bearish movement. So that's when trading around news events, you use limit orders to manage volatility and be aware of the potential for market overreactions. So the next strategy is spread trading. So spread trading involves simultaneously buying and selling related oil contracts to profit from price discrepancies. For example, Brent oil and the WTI. You can see this divergence. WTI is priced at $69.68, while the Brent oil is priced at $72.6. So trading trading with spread, you can exploit arbitrage opportunities when spread diverges from its historical averages. So by monitoring the correlation between these markets, you can identify mispricings and potential trade opportunities. So in conclusion, mastering oil trading requires a blend of understanding market fundamentals, applying effective strategies, and managing risks with precision. So you've come to the end of the video. If you found this video helpful, please like and subscribe to the channel, and don't forget to turn on the notification bell so you never miss an educative trading video like this one. Thank you for watching and happy trading.